Well, the self-storage REIT race is on. Who is going to win? All the major REITs now have announced their earnings. In fact, SmartStop's doing their earnings call. A very special guest is going to break down what these Q3 2025 earnings mean for you. Welcome to the Self-Storage Report. I'm your host, Chris Berg. Do acquisitions for Abernathy Development. Looking for some great pieces of dirt out here in California. Joining us today, our co-host, the one and only Rad Thad. Does some great work there at S3 Partners. And very welcome to our data partner, the CEO of Tract IQ, Noah Starr. So, gentlemen, great to have you with us today. I'm excited to talk about what these Q3 earnings are going to mean for people in the industry. Noah, I want to start with you. You've got a great breakdown of these REIT earnings. What I want to start with, though, is from what you heard from the earnings, what you saw, what's your headline? What's your takeaway?
And it's great to be here. I love talking to you guys and all the work that you guys do. And you always come out swinging with like the headline that I didn't necessarily prepare for. I think I want to dive into the data a little bit more before I come out with a sweeping takeaway, because I think there's a lot of different routes that I can go. So I wouldn't say I've formulated that just yet.
This is the really problem when we bring more newspaper guys on instead of TV guys, right? The guys he's one of those guys we get our news from. All we care about is the headline. No, exactly. We don't go in-depth analysis.
If it bleeds, it leads. Give us a headline, bro.
60% of people just read the headline and never read the story, right?
It's it's fascinating. I was at a mastermind. Scott Myers, God bless, an amazing mastermind. But I was talking about the REIT earnings reports, and it's fascinating to me that people that own storage facilities don't know necessarily what's going on, which is one of the reasons that we started the show, and really excited to have you dive into the data, because we think it's important that people do know.
Well, let's start there, actually, guys, because I think you bring up a great point. There's a lot of people I talk in the business, too, that really don't pay attention and may even say, I could care less. I think it's really interesting and important, but I want to hear your thesis. So, Noah, we'll start with you. Why do you think this data is important for people to know?
Well, I think I've been saying this for quite some time, but I think we're going to look back on this period in self-storage flabbergasted that we spent invested billions and billions of dollars into assets without actually understanding the true performance of the competition in the market. And we're investing based on website prices and square foot per capita and things like that. So I think when times are good and when the demand of storage has exceeded the supply, we have been able as an industry to kind of ignore that. But when demand softens and we overbuild and we overpay and we overlever and we jump the gun in many ways, this comes back to bite us. And I think that's what we're seeing holistically. So if you don't know what's going on in your market, you don't know occupancies, you don't know achieved rents, you don't know what the REITs are doing, how are you supposed to make informed operating decisions or investing decisions?
Thank you. Thaddeus,
can I just interject for 1 second? That little 40 seconds that Noah just said is exactly why Chris and I approached him to be our first partner on this show. It literally sums up in 40 seconds. If you don't know what you're buying, why are you buying it? And then more importantly, and this is why we're so proud to be partnered with Noah, how do you figure it out? Because some people don't know, only because the process of figuring it out is really challenging and they don't know how to go about that piece. So, this is why we love what you're going to share today. I got to see behind the curtain before Noah pulls it out, but the data that he's able to extract from the earnings calls and the earnings reports it's incredible how you guys are able to break that down for us.
But Thaddeus, your thesis, why is this information important for people?
He just said it. If you're buying something and you don't know the underlying metrics of what it's capable of earning, why are you buying it? If you don't understand you're going to buy a self-storage facility in a market and you don't understand what's happening in that market rate-wise, occupancy-wise, the number of people that are seeking storage, how are you going to be able to continue to lease up or raise rates? How are you going to make an intelligent decision on what you're buying? You're buying on hope, and hope is not a strategy that is successful long-term.
Yeah, I'd even make it, even since we're speaking headlines, be even more of a succinct headline. I mean, how many sites do these REITs own or operate, would you say? 10,000?
Over 10,000, just public storage and extra space, right? They're over 10,000 combined at this point.
So for those of you watching, I just want you to think about these people have got 10,000 spaces, places of data that they're monitoring daily that they're now got to spit out and actually publicly display what exactly is going on to give you an idea of what's going on in some of these markets, where trends are going, and obviously what these people are thinking, where they're making investments long term, so you can kind of be the Burger King, right? Be the Burger King. All Burger King ever does, or what good real estate people do, is, hey, where's McDonald's building? All right, I'll build next to them, right? So I think there's a lot of power and value in going through these, and that's why when you see what Noah's put together today, it's just really, again, Noah, I emailed you this, but I want to acknowledge you and your team. It is phenomenal what you guys have put together. So let's dive in and see what you got.
Yeah, let me share my screen and show the data here, and I'll even just be more concrete. So we're tracking that REITs manage or own 10,865 self-storage facilities across 70,926 total storage facilities in the US. So about 15% of the amount of storage facilities in the country, but it's about 30% of the total net rentable square feet in the industry is actually managed or owned by the REITs. So, huge amount of data that they have that the rest of the industry doesn't, unless you get reports like this. But here's at least some slides. That's a teaser on our Q3 REIT report that comes out next week. Should I just walk through this really quick as we digest the data?
I want you to walk through it, but also be open to Thaddeus and I interrupting you and asking you questions, because, I just think it's great what you put together, but I also want to give some context to people potentially.
Oh, I think we got a good rhythm on these things
good.
already. Yeah, feel free to
Like
just
Chris and I
jump all
ever
over
have
me.
a hard time interjecting.
All right. So we've got a couple of slides here. This first slide is showing Extra Space, CubeSmart, and Public Storage's achieved versus street rates, and that trends since 2020. And I'll start with Extra Space in the top left and navigate through. But you can see in the dark.
No,
Yeah, go ahead.
Well, again, we don't know exactly who's all watching the show. So achieved rate is what, and street rate is what?
Exactly. So the dark green line for Extra Space is their average street rates for their portfolio. And a street rate is, if you're looking on their website, typically it's the rate that's crossed out, but it's generally the rental rate if you were to walk in off the street and move into that unit. That's the dark green lines. The achieve rates are the actual rates customers are paying on average. So the actual in-place rental rates customers are paying, that takes into account existing customer rate increases and, normalizes all the data in that sense. So Extra Space, you can see here, throughout most of history, and we've talked about this a bunch, but throughout most of history in self-storage, the street rates were above the achieve rates, meaning if you were to move into the Extra Space facility, you're generally paying more than someone who's been there for a long period of time. You're rewarded by being a good long-term customer. In 2023, 2024, you can see street rates nosedived for Extra Space. They totally changed strategies as they saw softening in the market, and that led to them dropping street rates significantly. So you can see how they fell almost from $23 down to $15 or $16 and kind of stayed in that range until this year. The good news is street rates are actually elevated and up over the last year by about 32% year over year. So that's a positive, but still, they're below the achieve rates, which is that, light green line that has kind of been steady, but been falling, pretty consistently since 2023.
What do you attribute the incredible drop in street rates? Because as we look at this, the thing that jumps out at me is the old Chinese farmer proverb of "we'll see," right? Like, it doesn't look terrible when you look at the achieved rate graph. Yeah, there's been a drop, but it isn't terrible in any way, shape, or form. What do you think caused such a drastic reduction in street rates?
Yeah, the first is the obvious the Life Storage acquisition. They combined both portfolios, and I think a lot of that is attributed to the Life properties were potentially getting lower street rates, or in areas that weren't as strong from a demand perspective or a market perspective. So definitely there's some adjusting going on with Extra Space in particular because of Life. The other is, I think, the strategy changed significantly, and the strategy is different between CubeSmart, Public, NSA, SmartStop, and Extra Space. I think here, Extra Space, holistically was pretty content with lowering street rates, lowering web rates to try to boost occupancy and then make up for the lost revenue on the move-ins with, customer rent increases. But you compare that to CubeSmart, which is the one on the right, and it's a little bit different of a strategy where the street rates for CubeSmart have always been higher in many cases than the achieve rates. So I think you're seeing different strategies across the operators, and that's why we talk about why is this data important? If you're going to hire Extra Space, you're going to hire CubeSmart, you're thinking of a different third-party management company, or you're trying to underwrite facilities, understanding the nuances of these operators is super important.
So with this all being said, I'm curious your assessment on the fact that it's pretty rare to have negative NOI in this industry. We did see that last time we had you on, where it was the first time since the GFC, all the major REITs had negative NOI. What was interesting to me is that Extra Space, if I remember this correctly, is the only REIT this quarter that's had 9 months of negative NOI. Do you think the strategy is starting to maybe impact their business enough where they go, you know what, maybe this didn't do exactly what we thought it would?
Yeah, and I would just say NOI growth. So not negative NOI, but NOI growth year over year. I think all of the operators are very sensitive to earnings calls. And, I was on a revenue management panel last week at the TSSA show, which was the best stage show in the country, of course, here in Texas. And I was on with Ahmet from ProRise, and we were talking about, revenue management. This is a daily setup that these top operators are actively looking at every single day. It's now a point where you and I could log into the same facility at an operator and see totally different prices depending on where we came from, if it's on spare foot, things like that. So they're making these adjustments every single day, and it's never been a more dynamic environment, which is why I would argue, understanding rates at the aggregated and average level is potentially more useful than just looking at one data point. But they're certainly looking, and I mean, they're all, I'd argue, very short-term oriented of looking towards their earnings. And anytime you have negative NOI growth and you see your stock fall 10 to 15%, it's going to cause you to rethink certain things.
I would agree with that, but then when you listen to the Public Storage recall versus the Extra Space, I mean, it's pretty clear that these guys are going in different directions. The Public Storage headline for Thaddeus and I was that, hey, look, we've now cut man hours by 30%. I've got a clip I can play in a moment, but Joe Margolis was very clear, look, we're investing in R&M and we're investing in our people. We're going to continue to do that. So yes, I think they are obviously motivated by their, quarterly calls. And yet from the way my takeaway from the Extra Space one is, hey, we're making long-term investments here. Our R&M is not for the quarterly calls. This is long-term investments for our assets. They're talking about marketing the same way. Your thoughts on that, Noah?
Yeah, they're all a little different, and Public just has an outstanding development team as well. And they've been very aggressive in even building new storage development sites and stabilizing them to, pretty crazy yield on cost dynamics. I think that there's a lot of nuances between the two companies, right? Extra Space has really accelerated bridge lending. They've really accelerated on the third-party management side, not to mention their core business. While Public, a little bit less focus on third-party management. I don't know if they have a bridge lending program, right? So they've put all of their energies into expanding new developments, things like that. And these are just two different strategies to try to get to the same place, which is, stock growth, which is NOI growth, things like that. But definitely some interesting differences between, all these groups.
All right, let's go to your next slide.
Great points, Noah. I would just add, Public does have a bridge lending program. It is very small. It's an ancillary, similar to their third-party management, is not a core piece of their business. It's more something they do to aid the other pieces of their business.
Yep. I'm actually going to go to this slide.
This one blows me.
Yeah, so I'll go to this slide and you talk about really, honestly, let's go to this one first, and then we'll come back to the time series of occupancy, right? You talk about the nuances of the brands, right? This is a historic occupancy, same store occupancy chart for Extra Cube, Public, NSA, and now SmartStop since 2015. And you can see a bunch of differences by the brands here. You just think about NSA, right? Going into more secondary and tertiary markets, lower density, um, more impacted by, new supply, more impacted by, a slower housing market, things like that. You can see how occupancy has fallen considerably where they were all around, 96% occupancy in 2021. NSA is fallen significantly down to 85 or just under 85%. And if you just think about a lot of data that we have coming out in the almanac, a lot of people who are investing in stores, right? What is the better comp? Is it looking at a public storage Class A facility in downtown LA, or is it looking at a secondary or tertiary, NSA facility by a brand name that's well known but not the same level of public, where NSA is looking at 85% occupancy, right? So huge differences in just how to think about underwriting. But even here, Extra Space, with all the things they have done, have maintained occupancy the most out of any other REIT, while CubeSmart and Public have been more content to, let occupancy fall versus Extra Space. So all of this factors into, they're all trying to gain as much NOI per store as possible, but Cube and Extra are more content with letting occupancy fall more than Extra Space, which is really trying to maintain occupancy at the expense of street rates.
I think it's fascinating. The very first slide, you saw the dip that Public and Cube have shown in achieved rate is significantly less percentage to Extra, right? They've kind of, they may have gone down a little. Cube doesn't even look like they've gone down necessarily. And then you trade that off to occupancy. Well, Extra clearly sacrificed street rate and web rate for occupancy. Does it now look like the right deal? I had a fascinating conversation with Matt Lang of Ghost Stored a couple weeks ago. And one of the things he told me that I thought was mind-blowing is the days of buying things on gross potential rent are over, right? And so this idea of driving occupancy is, hey, we've got the occupancy in this. Now it's just a matter of existing customer rate increases, and you have this gross potential rent that you can earn. Of course, Matt Lang is the president of Ghost Store. They've got 150 owned stores, another 50 plus that they're managing, significant private owner. No, we're not underwriting to that anymore. We're underwriting to occupancy and the rents that we're seeing when we're going to sign somebody up. And so, in hindsight, does it look like, and I'm going to ask your opinion on this, Noah, like that strategy that Extra employed of discounting rates highly, and of course, influenced by the Life Storage acquisition, wasn't just something where they decided to do huge discounts. Is, as we look back, are you seeing that, hey, maybe that strategy wasn't the right way to go about it?
Yeah, this might be a hot take, so take it for
That's what we're here
worth.
for, man. Just call me Stephen A. Smith.
I would say that, I used to be an investor before moving on to the data side. And if you think back to 2021, 2022 acquisitions, the commentary the last number of years has always been something like this. Interest rates have risen, housing sales have fallen, storage demand has fallen, which results in the occupancy you're seeing here, all these trends. It results in, 2025 being the lowest occupancy reported that we're seeing since 2017. And you think about, well, aggressive ECRIs, you think of all these things. What no one talks about is that in the SSA demand study that came out, more people use self-storage today than ever before. So more people are renting storage units right now than they did in 2021 and 2022. So why are things so bad? Well, one of the things, or some of the things that I'll say that, no one really talks about is we've overbuilt drastically in markets that couldn't support new storage, or it's just going to take a long period of time. We've overpaid for storage facilities. And then we didn't just overpay, we over-levered storage facilities. So more people today are using storage. We have never been better as an industry at getting people to move in, at dealing with revenue management, and the focus has just been there. But the focus should really be on how do we make sure this year and next year, we as an industry collectively allocate capital correctly, which is we invest and develop in areas with high occupancies, high rates, and areas that really need storage. And we don't do that in areas that get blown up. And anecdotally, before I end my spiel, right, I talk to people all the time. Anecdotally, I heard about a deal that was just developed for $11 million somewhere in North Carolina, and the square foot per capita is now 30. Occupancies in the trade area have dipped, and developers are looking to get out at pennies on the dollar just to get out of the deal, right? Is that situation because we did aggressive ECRIs and we didn't revenue manage it properly? Or is that situation because we don't know how to underwrite and we haven't been allocating capital properly? So that's
I want to
my
bounce because I had a great conversation yesterday with a group that's done 1.5 billion in storage. They've got obviously a tremendous amount of experience, and we talked about show me the incentive and I'll show you the outcome. And also in Newport at the SSA, California SSA, best state, California Storage Association. Joking, Noah. So
New Jersey doesn't even have one, so I can't get in on this conversation.
California and Texas don't have any rivalry at all in anything.
We are our worst own enemies. And like the guys brought it up on stage, like, look, if people are going to continue to buy these things at 4.5, 5 caps, of course, developers are going to be like, well, if that guy can do it, I can do it. And they're not thinking about these other metrics. And so we become our worst own enemy, where we're incentivizing developers to continue to keep building because there's so much capital coming into the space. Thad and I have had this conversation for quite some time now. There's a bunch of funds out there that want 4 to 5% in storage that have got zero. I mean, Joe Margolis said this in Vegas, right? So you think about, these are major funds, billions and billions of more dollars now want to come into the space. There's only X amount of sites like you talked about. It's only going to raise those prices, put more, meat on the bone for people that want to do deals. And so to me, it's a very interesting dynamic and a tough puzzle piece, because look, if someone came to me and said, hey, I'm going to buy that at 4 cap, you're probably going to sell it, right? But is that the best move from the overall picture of, incentivizing more development? Probably not. So I want your take on that. Do you feel like we've actually been our worst own enemy in this business?
100%. And I mean, you talked about incentives. I would say the short-term incentives are definitely on, you get an acquisition fee if you buy a deal, you get a development fee if you develop a deal. But really the real carrot should be on your exit or on the cash flow stream generated by the facility. And I think, we've all fallen into that trap over the last number of years. And, historically in storage, the market has kind of saved us from this, right? It's, you're building in an area with like 2 square foot per capita. You have this thing that more and more people are wanting to use storage. Sure, people have had some tough times in storage, but generally the market has just grown beyond anything possibly anyone would have imagined, right? That it saved certain people. Now it's a very institutional market. It's a larger market, and you have to be smarter as an industry in terms of how we allocate capital. And I think we're seeing a lot of the harm of people not knowing occupancies and in-place rates is coming to the light. And there is a way to solve it, right? The hotel space solves it. Multifamily solves it. I've talked to lots of really, really large capital allocators that won't even consider self-storage because they can't underwrite it. Is that because of ECRIs are aggressive, or is that because us as an industry are afraid to, share information and make sure we're investing properly?
Get on your soapbox, man. Chris will tell you, I go on that soapbox at least once a month about new developments being done in a way where the people behind it don't really know what they're talking about or what they're looking at, especially in 21, 22, as that wave really peaked. So yeah, if only we could get to that place.
But I would say on the flip side of that, Noah, and you and I have got a mutual friend in Texas that we've, mentioned over text or emails at some point, where he's going out to institutional money and these institutions want storage. And then he goes, hey, look, I can probably do 100, 150 million. I'm like, I can't even sneeze at that. Like I need to deploy 500 million or whatever that number is. Right. So that's kind of what I'm getting at as well, is there's capital that want to get in, but it's not even big enough for some of these guys to put money towards it.
Yeah, there's a lot of dynamics. And look, it's kind of like in sports, right? The Toronto Blue Jays were an inch away from winning the World Series. And because they didn't win, you're going to have lots of people criticizing certain players and coaching and the strategy. And when times aren't going well, you find all the things that are wrong with it versus the Dodgers, of course, going back to back. Same thing with storage, right? When things are good, deals are moving, occupancies are up, it kind of sweeps all this stuff under the rug and we don't really need to talk about it. But now, when you see the worst occupancy performance that we've recorded, you see NOI declines across most of the REITs, you see all the challenges that we're facing. I mean, that hopefully this is where things change. And this is where, we come together as an industry to make progress on this because it's unsustainable.
The reason I'm laughing is we might as well just put a big red flashing light, like developers go away, right? Like just, there's
like
nothing,
learn, at least learn.
wait, let me be Obi-Wan Kenobi for a moment. There's nothing to see here. Right? Like just, hey, developers, go somewhere else. Sorry, Thaddeus, go ahead, man.
No, I just had a conversation with a friend of mine, a developer who built a facility, 160,000 square feet, a market that at the time looked like it could sustain it. They opened, they're 2.5 years open. Another facility opened across the street a month before them that they didn't see in the pipeline until they were already committed, right? They were already $500,000 into the project. They built anyway. They're at 85% occupancy, 30 months in. They're at 35% economic occupancy. Now, their IO came up a few months ago, right? They were going to have to start paying principal. They're not making enough money to pay the principal on the debt. Their banker called them and said, hey, how would you like an extra 12 months of IO? A question, by the way, that nobody has ever said I wouldn't like that to in the history of that conversation ever happening. But this is what's kind of saving self-storage at the moment is the banks are the banks are eating some of that on their side of it. And I've heard this in many occasions. Not only do you have the extra bridge lending program and things like that filling in that gap, but you have banks that are just saying, hey, we know that if we don't give this person an extension on the IO period, they're not going to make it. That facility, by the way, is for sale and nobody's buying it at a price that's going to get them out from under what they owe. So what's their option? Fortunately that the banks are kind of helping solve some of that problem. And people I've talked to in the industry, they don't think there's going to be a bloodbath come down the road. But to Noah's point, what's the problem here? What's the real problem that we're undergoing in the moment in storage? Overdevelopment.
Well, and no, I want to see if you concur with that because you just mentioned a moment ago that there's some assets that sound like in North Carolina and South Carolina, pennies on the dollar. Do you consider that a bloodbath or no?
I mean, it is for the equity holders, right? I mean, it is for the lender who the debt isn't being serviced and they might have to take a haircut. I mean, that I think is the analogy of a bloodbath. I think that is what that is in the context of finance and investing. So, I think us as an industry are our own worst enemies in many ways. And I do think, I'm self-motivated, right? We're a data company. There's an ulterior motive here and we're a business and all that kind of stuff. But taking all that out, I just don't think people realize that this is a major problem. And, it doesn't seem like there's any movement on trying to fix this outside of the things that we're doing, which, I think we will fix this as an industry in the coming years, but it takes having real conversations. And, you asked me for a headline when we first got into the data, Chris, and I don't know if I'm still ready to give it, but, we can come on here and we can just sound happy and sound good about the state of the industry and get all excited about the data, right? Because it's great data. But the truth is, there's very few people that are publicly talking about the real issues in self-storage. And that's a big problem. I know there's a lot of private conversations, but very few public conversations. And it's the same song and dance about revenue management, this, and move customers in that. And, I think at least I'm trying to have the real conversations. And I know you guys are too. And even if it upsets certain people.
Yeah. No, thank you for being so candid. A moment ago, hey, you said we're going to solve this or at least do it over the next few years. What are you solving for exactly?
People need to know what's going on. People need to know what, the occupancy is. People need to know how revenues are trending. People need to know, what's actually happening at what performance drivers are happening at these facilities, not what their website prices are, not what the square foot per capita is. We need to actually know what's going on. And, there's a perfect solution that is impossible, but there's, half-baked concepts that at least try to get us towards that future of kind of like the hotel space where they can, download a report that has all the nearby hotels, occupancy and RevPAR and expenses and performance. And if you were to go talk to hotel investors, how much more efficient of a space they've become, how much money has been saved because of, not doing bad hotel deals. Go talk to those folks, right? We're not reinventing the wheel. This has been done in other industries. We just kind of need to follow along.
All right. Anything else, Noah, that you want to share from your presentation?
I think there's just a lot of great data that's coming in our Q3 REIT report. I don't think it's going to be as candid as what we've shared today, or at least what I've shared today, but some really, really awesome data. And I think we're just scratching the surface of what's possible to do in self-storage in terms of understanding what's going on. But it definitely starts here at the REITs.
All right. So I want to go in a similar but a little bit different direction, and then we can have this conversation, because I did a post earlier this week talking about who's going to win the REIT race, right? And if you listen, let's just talk PS and ES right now. But as I mentioned a moment ago, Public Storage, hey, we're cutting man hours by 30%. They are leaning heavily into AI. 85% of their interactions now are digital. Extra Space is like, yeah, of course we're doing digital, but we're putting big money into our R&M, and we definitely are going to invest in our people. And I want to play a clip for you here real quick. This is Joe Margolis, if I can figure this out, from the earnings call that I think was really, really interesting. Can you guys see this okay?
Yep.
All right. Hopefully you can then hear it as well, and we'll get your take and who you think wins the REIT race.
To a competitor. So as long as we have customers who are choosing to walk into the store, we will make sure we have a store manager there. Because if we cut expenses by 15% and lose one rental a month at our average rate, that's negative 2.5% NOI experience.
It's a big statement. Cutting expenses, moving their NOI. I don't know how he comes up with that math, but who do you think wins the REIT race? More digital or more investment in people? Noah.
Thaddeus, you want to go first?
I definitely lean towards digital. Especially you talked earlier, you brought up the stat about more people renting self-storage right now than ever before. Well, that's really driven by millennials and Gen Z using storage at such a higher percentage than baby boomers did, in my estimation. And quite frankly, there are a lot of Gen Z, of which I have children, they don't want to talk to somebody. They're more comfortable on their phone than they are with a manager. That doesn't mean there aren't still people walking into stores, but I think as we move forward the next 5 years, 10 years, you're going to have more people that are very comfortable without a human person-to-person interaction. It might be on a cell phone, might be on a tablet, it might be on a screen in the lobby of the store.
I would agree with that. And then if you look at the demand study coming out of the SSA in Vegas, they clearly stated that people say, hey, I want to have human interaction when I go into a storage place. So I think that's where Joe Margolis is going. But also, we've talked about our thesis here. No, and I don't want to preempt your answer because I want to get that. But I think there comes a day where I literally just talk to my Tesla and go, hey, go pick up my bike at my storage unit. It goes, a robot puts the bike in my Tesla shows up, I grab my bike, go for a ride, and put it back in storage. So who wins this REIT race? AI or invest in humans?
Yeah, I think I don't know if I love the choice. I just don't know if I think that's like the
decision. Told you, we're TV, we're not newspaper, brother.
I think I was asked a question on a panel last week, kind of similar about this. And I think it really depends on your market. And I think everything should revolve around that, what your market is, and then what store are you talking about? If you're in a Class A facility in Los Angeles proper, and it's a really nice Extra Space branded facility where they're going to get $25 rents, plus, that's a different product experience than a 20 to 40,000 square foot facility in, Springfield, Ohio, right? Or Springfield, Tennessee, or
Yes, sir.
Waco, Texas, right? That it's just a different product, a different market, and a remote managed facility could make a ton of sense because the rental rates in that market could be half, right? So you can't even afford a full-time manager for that site. And that kind of customer would rather pay less for a less secure, non-human experience, so long as their stuff is safe.
Okay, so let me take this path on a question with you then, because of your background as an institutional investor, you've got 100 million, $250 million to invest in storage, right? You're running that right now. That's your portfolio. Do you go out and build a portfolio of Class A, LA, Austin, Florida? You pick kind of the big urban market, 3 p.m. with people in it. Or do you think there's going to be better returns by you going out and going maybe into the Midwest, no managers, it's all automated, and that's where I'm going to go deploy this capital?
Yeah, I love this question. I ask myself this all the time, and love Charlie Munger and I love Warren Buffett. Yeah, I've got some good stuff. Here's Charlie.
Are you the only person
We've
in the
got
world with a
Warren.
bust of Charlie Munger in
There
his
you
office?
go. And by the way, you bet that my wife and my friends got this for me because I'm crazy. But you
Dude,
know,
can we just pause for I love you, man. Like that was the greatest thing ever. Like, hey, let me just show you what I got here. That was awesome.
I think you might not like this answer. It depends on the capital, and it depends on the risk-adjusted returns that you're seeking, and it depends on what you're trying to build. For example,
Pause. You're Charlie Munger. These guys, they want to mitigate risk, right? Hey, if I'm going to buy something, I'm going to buy and hold forever. I'm not looking to recycle capital, which again, I don't know if that's the most efficient. So I understand what you're saying, but I'm saying someone hands you $250 million, it's the Noah Starr Self-Storage Fund. You got to go deploy. What do you do to maximize returns? And I'll give you a 10-year time frame.
See, maximizing returns is different, right? And I think if you're going to invest in Class A, premier markets and have one of the REITs manage your facilities, there's not a ton of upside in that example. You're competing with public, you're competing with, all the biggest capital groups in the country that have really low cost of capital, and they're buying in place 5 to 6 caps, right? So, over that 10-year period, if you're going to buy in place 5 or 6 cap rates, your returns, levered or unlevered, aren't going to be that high. So if the point is I want to maximize returns, right? I want to have the highest outcome, right? It's probably not in that product type, because that's not generally people aren't generally trying to maximize returns if that's your investment type. Like, versus public storage doing a development deal, that's a way different risk profile and a different upside potential than just buying an existing facility. So if I'm maximizing returns, it's probably a combination of things with the capital, right? I would, if there's $200 million of equity and I can raise, 50% debt, so I've got $400 or $500 million of storage that I can invest in, it's going to be a combination of, some development. It's going to be some just buy existing, ideally undermanaged, undervalued facilities that I can, manage better. It's going to be all of it. I don't think there's one, I would throw it all into one strategy, because, one of the best deals I ever did was sourced off market by a 85-year-old guy who managed the facility for 15 years. He had index cards at his store. And he didn't even have financial statements. I had to look at his bank statements and his tax return and try to kind of back into what it was. We ended up buying a 9 cap and we flipped it for a 6 cap, right? I would want to do that all day long, even if, and wouldn't want to take away the opportunity for that based on strategy. So I'd have to give it more thought, but it really just depends on your goals. And that's why being super specific with what your goal is, what you're investing in, what outcome you're trying to seek, then you can kind of back into some strategies to help you get there.
Thaddeus, one more comment, because I saw you put your hand up, but I do want to share this and then get your guys' take. So, Noah, at some point, I hope that you can be my chief investment officer. All right, the way that you just ran through that in your head, and I say that because, are you familiar with Howard Marks?
Mm-hmm.
So he's got the great story where he sat down with a guy that was running a pension fund. I think it was out of Minnesota. And he's like, "Hey man, how are you performing?" Right? Thinking this guy, because he was crushing it over long periods of time. And he's like, "Oh, I was, number one, number two." He's like, "I think I was like 24 this year, maybe 27 the next year." And Howard's point was that over the long term, I don't need to be number one and number two every year because there's too much volatility there. But over the long term, him being at 24, the guy was crushing, his returns and doing the right thing. That is what we're going to say.
I was just going to scratch my head. I'm sitting here listening to really, really smart people and by default getting a little smarter and enjoying it. Yeah, Noah's I go back to what I said earlier. We're so glad to have brought Tract IQ, and we're so grateful that they agreed to come and be partners with us on the show. Our goal and our mission is to get this information out to people in storage. It's why you and I decided to start this show. I joke about us being news people. We're passionate about people understanding what's really going on. That's a joke. We want to get in depth, and to have someone as intelligent as Noah with the capacity that his team has to put information together to share with the audience. I'm so grateful just to be sitting here and absorbing it. Hopefully a bunch of people, find the same need to absorb that information as well, because, if you're not knowing what's going on, you're not making great investment decisions. So Noah, unbelievable, and can't thank you enough for everything you shared today.
Yeah, no, what I
Yeah.
want to give you an opportunity. Go ahead.
I was going to say, I appreciate it. Appreciate you guys and love working with you. I think I've made a lot of mistakes, and I think a lot of investors in the last number of years have made a lot of mistakes.
Yeah.
And the best investors learn from them. The worst investors pretend they never happened. And, so as I've navigated from an investor into running Tract IQ and committing to no longer buying properties, right? I've made mistakes and I see the pain of a bad deal. Like I really get it. And I think it's really anxiety inducing. It's disappointing to your investors. It's disappointing to the people that support you and think you're great. And no one talks about it publicly, right? I know people privately, I'm sure there's a lot of stressed out people right now in self-storage. I have been one of them and I get it. And, but all that experience allows me to now have a better philosophy of how I think about investing in storage, what I think the problems are and what we can do to fix it. And ultimately, I need to do a better job of just communicating all of this out because, so few are able to talk about it. So I love that you guys give me the space to talk about it with you guys, and love all the work that you guys have been doing.
You kind of read my mind, Noah. So I want to give you the last word here. And I just want the people watching to just take a moment and think about what you've heard here from Noah, and then imagine having him be your partner at Tract IQ as you're utilizing that tool to go look at sites, underwrite things, and have the best information possible to ensure that you're not going through the anxiety and letting people down like Noah just talked about. So Noah, for people watching and thinking, hey, you know what, this Noah guy knows a lot. He's been there. He's done it. I can learn from him. He's got great data. Why should people come and work with Tract IQ?
I think that, we're not a big company. We only focus on self-storage and we've been investors. I think we get it. We're trying to build the easiest product to use with the best data so that you have all the context you need to find and analyze storage deals. I think you asked me at the beginning of this what my headline would be for the REITs. And I think my headline would be something like, the industry is going on a new awakening, and kind of around this idea of we're starting to really understand the problems that we have as an industry. And I think we have some really smart people, you guys, part of that to help us address them.
Great stuff. Again, go to TractIQ.com. Say, hey, I heard about these guys on the self-storage report. They will be more than happy to take care of you. No, we appreciate the time, the insight, what you put together with the presentation. Thaddeus, I'll give you the last word. Anything else you want to add or share?
Next level from Noah, as always. Appreciate you so much.
I appreciate it, guys.
All right, gentlemen, that's a wrap here on the self-storage report. Again, TractIQ.com, TractIQ.com. Check them out. Noah, we appreciate the time.
Thanks so much, Noah.
Thanks, guys.
Thaddeus, I want to give you the last word because I know that you've got also a special message from one of our partners.
Yeah, just going to give a shout out as always to our friends at Johnson Insurance. Want to tease a little bit next week. Our friend, I hit preview instead of live, Chris. There we go. I got to hit live. I hit the right button. Terry Campbell. He's going to share something with us in next week's show that is mind blowing about a property that he's a risk adjuster for Johnson Insurance, a portfolio that he put under the microscope for an owner. And, to see, God, there we go. My guy Eric took care of me in the background to get us both up there to see what he saw in this portfolio. So we're going to tease the show next week and unbelievable what happens. Just a shout out to everyone. Go check out your insurance package. Make sure that you have coverage for everything, because God forbid something happens to your facility. The last thing you want, it's like having a car with no gap insurance, and all of a sudden you owe $20,000 for a car that got totaled, right? Because you're missing a little piece of the puzzle. Multiply that into a 10, 12, 15, $20 million self-storage facility, and it hurts a little worse. So go Johnson Insurance. You can get Terry to underwrite, or his team to look at your current package and give you insight into what it looks like. But tune in next week, because we got a very interesting clip that we're going to share with you.
Awesome. What was your best takeaway from Noah today? I mean, that was outstanding.
Like, just blessed to be partnered with someone so smart, so dedicated, so hardworking. My biggest takeaway from him is that piece about, we don't have an ECRI problem or a rate cut problem. We have an oversaturation problem. And, I said it before, I'll say it again. I'm always humbled when other people that are really smart agree with something I talk about a lot. And I talk about a lot. If you're developing, partner with people who know what they're talking about. Go get a call with Noah, join Tract IQ, use their platform, and, talk to people that have done it before, because the single greatest threat is overdevelopment in my estimation. So, but for him to say that made me feel, a little bit better about my own intelligence level, which was nice.
Well, I just love the fact, like, you can see his heart for the developer, right? That he's just like, look, whatever you do, do not make this mistake. This is a 10, 11, $20 million mistake. If you just think, oh, I'll just put it up, and it's not how this game works. And so I really appreciate his frankness and honesty. And just, there's nothing worse. Can you imagine losing $20 million when you thought you had a home run? So again, if you're even thinking about it, go to TractIQ.com, tell them, hey, Thaddeus and Chris sent you over there. They'll do a great job taking care of you. But again, it's TractIQ.com. This is the Self-Storage Report. Thaddeus Campbell, Chris Bird. We'll see you back here next week.